quick 10-minute break is over. Thank you, everyone, for staying close by. At this point, please welcome to the stage, again, representatives from CoStar, CBRE, Cvent, AirDNA, CBRE. We're going to talk stats, ADR, RevPAR, the whole 9 yards. And again, as Teague said yesterday, how many of these predictions will age badly since we've had 3 since January. So please welcome to the stage our statistics panel. Thanks, guys. Hello.
All right, we're going to be golden, guys. Hello. Thank you to all 12 of you for coming back from your break. We appreciate you. We have, well, an hour worth of data for you. We got 5 panelists plus 10 minutes of data each, so buckle up. My name is Jan Freitag. I'm with CoStar, and I want to give you the state of the industry the way we see it. Wow, of course, went way too far. So I want to start out with the forecast. This is not different from what we released at Alice. Last year, we ended up with a red zero. GDP growth was, pretty healthy, and RevPAR declined, which is very unusual. This year, we're proposing, okay, it's going to be a little bit better. We're trading a red zero for a black zero, so RevPAR growth of 0.6%. If you go down through the KPIs, supply growth, as you've heard this morning, continues to be muted. It's really hard to get anything done. Demand growth, unfortunately, is even more muted. So supply growth outpaces demand growth, which gets you occupancy decline, which gets you to almost no pricing power. So room rate growth is below the level of CPI, which is what all the owners and the operators in the room have been bemoaning for a while. And then for next year, it's a little bit more of the same, a little bit more demand growth, and a little bit more pricing power that gets you to 1.4% RevPAR growth, which is basically, if you want to put lipstick on that, double the rate of this year, but still doesn't win us any prizes. We live in some really weird times, and I wrote this up on CoStar News because I couldn't make sense of any of the underlying fundamentals. Normally, GDP growth drives demand. That wasn't true last year. And normally, because we can reprice our hotel rooms every night, we're able to outrun inflation, so ADR outpaces inflation. That wasn't true last year either. And thirdly, when the dollar comes down, it makes the US more attractive and cheaper for international inbound. So as the dollar comes down, international inbound should go up. And that wasn't true either. So I don't know anything. So that's what I said here. Everything I thought I knew is wrong. So take that as a background to everything I'm telling you this afternoon. When we're looking at the breakout by class for 2026, the bifurcation story that we saw last year continues to hold. So luxury is the only place to hide. RevPAR growth is actually pretty healthy. Full-service hotels, large group boxes like this beautiful hotel, they're going to be okay. But then the middle-of-the-road limited service type properties, a lot of you are exposed to that. We're suggesting it's really going to be another year of tough sledding. We used to say, oh, the tax refunds are going to really help the American middle class in order to do another trip for summer break or a long vacation. The problem is that the increases in the oil prices are arguably going to take out all the money that's going back into the economy out of the economy through higher gas prices. So we're not super optimistic that this is going to change, but we'll see. The first 2 months or so were a little bit better. We still get the question about comparing it to 2019, and I just want to make this one point. Room rates compared to 2019 are up today, or in 2025, 22%. That's great, except inflation was up 25%. So in real terms, room rates are now lower than they were pre-pandemic, down 3% or so, and the same math obviously holds for RevPAR. And that's the problem that you in the operating environment, in the operating business, all are facing, right? That the ADR, the top line growth, is not outpacing the middle of the P&L, which gets you to margin compression. And that's what I'm trying to show here. These are the margins in 2019, 24, 25, GOP margin and EBITDA margin, and you see that there's a drip, 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 step down, step down. Part of the reason, of course, is the higher labor cost. I've talked to a lot of you yesterday and today about access to labor, and it sounds like you're saying, nope, I think we're good. We can get the labor. It just costs us a lot more. You heard this morning about union conversations, union contract renewals in LA, in Boston, in Chicago, in New York. All of that is not going to help with our conversation around labor cost. But so that will then impact margins because the top line just isn't growing. Wow, yeah, and that's all pretty negative. Do you have anything good? Yes, I have one good slide for you. Look up from your phones for a minute. This is the good slide. So my friend Isaac Collazo texted me this morning at 2 a.m. and said, it is true. February was the strongest demand February ever. We sold more rooms this February than in any other February before. So that's good. So what I'm charting here is 4-week moving average of RevPAR, and something has changed, according to Isaac. I'm like, Isaac, 1 month does not a trend make. You know, I'm not sure we're quite there yet, but he's insistent that, yes, this is the beginning of something different. The good news is, as you can see here, last year after the tariffs were announced, RevPAR decelerated. We're now getting into an environment of very easy comps. So it's not necessarily that the industry is doing well, but the math is easier. And so hopefully that then means that we're able to show you some better performance on your STAR reports. Real quick on the World Cup. 11 markets in the US. We're proposing that between that time frame, June and July, they're going to drive RevPAR up. It's not going to be 48 Super Bowls. Trust me on that. Because we're hearing, wow, the FIFA room blocks are washing tremendously, 50, 60, 70% or so. International inbound, still a wild card. You heard Adam Sachs yesterday. He's quite optimistic. I hope he's right. I hope he's right. But overall, what we're proposing is that the World Cup impact on the national data is going to be 40 basis points for the year. So our RevPAR forecast is 0.6%. Without the World Cup, it's 0.2%. So yes, there is some lift. And your mileage may vary. Kansas City is going to do tremendously well. Dallas is going to be pretty well. New York City, okay. And I guess the other forecast we have to make, I think we can say with certainty, is that Germany is going to be in the Final Four. You can take that to the bank. My colleague Jake did a super fascinating analysis that I can't explain to you right now because it'll take a PhD in 2 hours. But what he did is he looked at individual countries when they were playing the last World Cup and last Euro and talked about the individual countries in which market they are, what the lift is on RevPAR, broken up by ADR and occupancy. So if you're in the market that hosts Argentina, Ecuador, Uruguay, France, Belgium, yes, you are going to see tremendous impact because those fans like to travel and like to spend. Let me finish with 3 slides on real estate. Number 1, pipeline, nothing to report. 136,000 rooms in construction. That is really low. We normally have between 150, 160,000 rooms in construction. So it's really expensive. You heard this morning, Mr. Shaw explained, you can't, with a 5-year hold, you can't underwrite anything. So new construction, we expect continued to be muted. Of course, if you have a much longer hold period, maybe you can make it work and you'll be the new kid on the block for a long, long time because nobody of your competitors can afford it. But what that means is that brands who try to increase net unit growth, if they can't do it through new hotels, they have to do it through conversions. And yes, the conversion numbers are up and continue to be up, and we fully expect more conversion activity this year. You see we're at the long run average. We're actually still below 2011 and 2012, so that's definitely something to keep an eye out on. And then lastly, on the transaction front, and we'll hear more about that from CBRE, what I think is that there's a little bit more optimism. You heard it this morning in the Wall Street panel. People are looking. There are still pockets of resistance. And what we see last year is that every quarter, the total volume of transaction has gone up, 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 like in the song, compared to the prior quarter. So we've heard at this Hunter conference for the last couple of years muted optimism. I think we're finally there, and I think 2026 we're going to see a lot more activity on the transaction side. With that said, if you found this interesting, please join us once a month when my colleague Isaac Collazo and myself dissect the monthly data on our own little podcast. It's only half an hour, but we have a good time. We talk a lot about the data, so join us. It's called Tell Me More, a hospitality data podcast. Thank you so much for your time. Have a good conference.
Thank you. Oops. So I'm Cindy Estes Green, and did I skip a slide?
You're good.
Is there a little bit of delay? From Calibri, and we have a new product called Hummingbird Market that is the source of the data where we talk about all the market, sub-market data, forecasting for the US market. And one of the things that I'm going to do today is I'm going to show some big picture numbers, but I'm going to talk more about the composition of RevPAR, because when in a world where profit matters as much as it does today, understanding what that RevPAR comes from in terms of the channels and how much we pay to get it. Hotels are paying 20 to 30% of guest paid revenue to get their business now, so it matters where it's coming from. So big picture, just looking at the last few years, the red line is 2025, and I'll just kind of quickly run through. The demand has still not returned to 2019 levels. I think we know that. Jan just talked about the average rate. Even though the average rate, that red line, is above 2019 and the last 2 years, we still, even though it's the rates are higher because of inflation, the real rate is actually not improved. But the rates grew a lot post-COVID, and you can see those patterns by month. And then if you look at the RevPAR, you pull it together, and essentially the reason why we came out with negative RevPAR this last year was because the demand levels were just enough to pull that average rate down and bring us just below previous year numbers. So one of the things, just on a really good note, because we're looking for some positive news here, when we look at it by day of week, and you can see the RevPAR by day of week, since COVID, we have managed to have this Thursday to Sunday period that has actually grown pretty substantially over that black line at the bottom that you can see, which is 2019. Even though it came down a little bit for the weekends, which is that Thursday to Sunday period, the midweek was actually substantially stronger, and getting that Monday to Wednesday to come back while we keep the Thursday to Sunday strong is one of the best things for the hotel industry, because the Monday to Wednesday eventually will come back and we will be overall stronger than we were pre-COVID. And I know this has taken a long time to get there, but the trends are there. And because of people working from home and so much more remote working, that Thursday to Sunday has maintained a really good, strong position. Even though it's come down a little, we still are stronger than we were in the world before COVID. Some interesting things with length of stay. The overall length of stay for the US in 2019 was 1.9 nights, and it's a little over 2. It's like 2 point and change. So that's good that you have longer stays. It means there's fewer guests, but if they stay longer, it's actually, they are more profitable. But some of the interesting points that we looked at with length of stay, when we look just at the one-night stay guests, we can see that the two categories, the two economy and mid-scale hotels, had substantially more one-night stays in 2019. And as we saw the business drop off, and we know that the lower tier and middle tier has suffered more through these recessionary times, a lot of it is one-night stays. So the longer stays have actually grown, but the one-night stays have dropped off, and that's part of the reason why the lower and middle tier has declined more, because that we anticipate it being, it's more commercially driven, it's more weekday driven, and that business has dropped off, and that's kind of the missing piece for the economy and mid-scale hotels. On the flip side, if you look at the 7+ night length of stay, all the growth has been in economy and mid-scale. So when you look at the differences between overall performance, which was -1% last year in terms of demand, When you look at the lower tier extended stay and even the upper tier extended stay, they actually landed at a +2% on demand for last year, which is super encouraging. So besides luxury that Jan pointed out as the strength, I would say the lower tier extended stay is the other ray of sunshine in terms of opportunity. When we look at channel mix, so I talk about looking at the composition of RevPAR, brand.com and OTA have continued to be in like a horse race because the property direct business that used to be as high as 60 and 70%, 10 or 15 years ago, is down to below 30%. And all of it's going to electronic channels or digital channels between brand.com and OTA. Brand.com has maintained a lead over OTA, but OTA has been growing over time. And what's happening with AI and where the sales path is going to lead is still uncertain. But that horse race continues, and from a profit point of view, the difference I'll show you in a few minutes is pretty substantial between direct business and third-party business. So just to talk about net average rate, so if we look at brand.com, in 2019, even though the top line rate was 152, the hotels were left with 144. Rates all went up by 2025. We're looking at $180, and we're keeping 171 of it. Just to look at OTA, you can see that there's substantially less, even though the top line is a little bit lower, there's substantially less that hotels keep. And if we look at GDS business, which in 2019 was actually netting higher than brand.com, has actually come down and is not as profitable as the brand.com business. So brand.com was higher than OTA by $42 in 2025 and by $9 for GDS business, which is a pretty substantial change. The QR code, by the way, will get you copies of these slides if you're interested. I have them on several of the slides. So speaking of OTAs and leisure business, it's interesting to be able to see how many markets were actually above the national average, which was around 21% demand for OTA. And you can see there's 18 major markets. Not surprising, New York and Miami lead the pack with high 30s as far as the percentage of demand. And, but of the top 50 markets, there's 18 of them that are actually exceeding the national average. If we want to look at how that compares on the brand.com side, we can see that brand.com has gotten, it's pretty close to 25% as of 2025. And a lot of that has been driven by loyalty contribution. Loyalty contribution for the branded hotels is close to 60% now overall. So I mentioned that the profitability is substantially more for brand.com business. So we ran an analysis to see the loyalty business, the loyalty member rate business that's discounted going through brand.com net of all costs versus the OTA business net of all costs. There's a 21% advantage for brand.com, and it's actually a $28 on average difference, which again is huge. So in a world that's very challenged with profits, understanding the composition of RevPAR becomes critically important. When we look at brand.com and unpack it, the two categories that grew in terms of the rate categories going through brand.com were discount rates, loyalty member rate, and advanced purchase. And the business that went through brand.com that declined was rack, bar, and government. And the main reason for government in 2025, it dropped 13%, and that's because of all the DOGE activity and the cuts and everything else. So quickly, just looking at our forecast, which I'm sorry to say is not as optimistic as CoStar's. If we look, our numbers showed a downward trajectory last year of 24 to 25. I think CoStar, you were 0.3 down. Yep. We're 0.8 down. Our database is slightly different. We collect over 30,000 hotels daily data, and we get all the detail by rate category and channel. But the data set that we have was showing down by 0.8. And our forecast, I'm giving it in a range because anyone who thinks they can give a forecast that's an actual number is wild guessing. So in this climate where there's so much that's unpredictable. So our range is from -1.5 up to +1%, somewhere in that range. When I was at Alice, I said I'm going to pick a number, and we pegged it at -1. I haven't moved off that. So we have occupancy down by 1.5 over previous year. We have average rate up by 0.5, and we're netting out at a RevPAR growth of -1. There's a lot of uncertainty. I hope that STR is right and it's on the plus side, but there's just too much unknown. We just went to war, remember? That happened recently, right? So again, looking at our forecast, where is that coming from? I told you that brand.com and OTA are in a horse race. Some interesting differences. GDS and corporate business had dropped off. So the GDS business is actually growing. It's kind of coming back to where it was, but it's not going to keep growing. It's never going to, it's been running about 10-ish% of total demand. And even though it dropped off from that, it's kind of just come back to where it was. So it's showing growth, but it's really not going to continue growing, whereas brand.com and OTA are likely to continue growing. And that's, you know, kind of roughly flat overall, but the brand.com growth, we see OTA being a little bit stronger growth this year because of the leisure focus, because of the World Cup and the America's birthday and all of that. We think we'll have slightly more on the OTA side, but we are still seeing brand.com growing slightly faster. And finally, looking at rate category, the government business, which dropped off 13%, is definitely going to be coming back. Not all 13%, but there's expected military spending that's going to make a difference. And you know, when we see what we think is growing, again, the discount rates, the government will come back because of what's happening with military activity. OTA, loyalty member rate, and an other category that's like AAA, advanced purchase, AARP. These are the growing segments, and the leisure business has definitely exceeded commercial overall. It was the reverse before COVID. But what we're seeing now is much more reliance on the leisure business, and we're seeing that Thursday to Sunday growth, and those are all actually very positive. So just to sum up in terms of takeaways, the average rate post-pandemic, we've all seen a leveling off of that. This uncertainty we're in is leaving us, you know, not knowing exactly where we're going to land for the year. The leisure is continuing. Corporate costs are very high. So you've got other segments that are more profitable, contributing overall to hotel profitability. The two bright spots are extended stay and luxury. The one-night stays are part of what's driving the economy and the mid-scale hotels to be, you know, the downward pressure on them. The loyalty programs are still a tailwind, and this strong foundation of brand.com will persist in terms of a support for hotel profitability. And every market is so different, and every sub-market is so different. It's really critical to look at each one, because the averages overall can be misleading, and you want to know what's happening in your market where your hotels are. And I will now turn over to Andrea. Thank you very much.
Let's see. Hello, everyone. Good afternoon, I think, by now. So I'm Andrea Gregg. I'm the Global Head of Hotel Asset Management. So I focus a lot more on operations than statistics and research. But thank you for having me on this panel. So a little bit of a mix of what we heard from CoStar and Calibri Labs. I think what, you know, the one thing that is certain is that wildcards keep coming. These wildcards are meaningfully impacting not only stats, but also the way that we look at the business. And another for sure thing is that no market is behaving similar to others, and even assets within the same market are showing a different performance metrics, and it has never been more important than focusing on what are the drivers for your property, for your market. So, but as we look at general statistics and US overall, let's see if we can go to the next one. Maybe not. There we go. So similar information as what we have been presented so far. So Q4, specifically RevPAR, shows some softness, specifically a 1.1% decline in RevPAR. So what led to this? Well, again, Q4 was a bit of the continuation of what we have seen year-round, which was a lower occupancy, 2.1% in lower occupancy, and a 1% ADR gain, but not enough to really have a strong impact in the overall Q4. This modest Q4 softening, we need to look at compared to Q4 2024, where we saw a significant RevPAR increase, had different demand drivers, and a momentum that we couldn't see in 2025. Now, despite what we saw in Q4 2025, we are expecting a more positive picture for 2026. So here, again, just a bit of a focus on Q4 2024. You see a 3.7% RevPAR gain for the quarter versus Q4, a decline of 1.1%. Rate discipline. So yes, the industry, and let's if there's any brands up here, continue to protect our ADR has been something that we continue to push for. As the expectation is that demand softness and volume softness will continue to shape the way that we look at performance for 2026. So this slide specifically shows the quarterly occupancy for Q4 2025, 2.1% decline. That was made up of 1.3% of actual demand decline and a 0.8% of increase in supply. And then again, relatively to the 1.9% increase in Q4 2024. So tough comps to follow quarter-over-quarter, year-over-year quarter comparison, but some perspective of that 2.1 decline. The Q4 2025, 1% increase in ADR, very much welcome, but absolutely not enough when we had a baseline inflation of 2.8%. Something that was mentioned earlier is how difficult it is to drive profits in today's market. Well, a 1% ADR increase with a 2.8% inflation and on ever growing operational costs is making it very tough for the bottom line. Let's see. I spoke then earlier as well, the K-shape split defined Q4 as well. So what we saw is urban and resort has seen modest growth in RevPAR during Q4, but again, not enough to really make us feel too happy. But as we look at the segmentation of luxury specifically, is really the only segment that is outpacing inflation, that is taking advantage of the high net worth business and driving a true, real, meaningful RevPAR growth. See. The gap between inbound and outbound continues to widen. If we look at, we are at inbound 87.5% of inbound tourism, which this sharp decline, it accelerated after Liberation Day or April 2025. It has not recovered. We have high expectations for the World Cup, but yet to be seen. And outbound, on the other hand, has grown by 4.9%. So the gap now that we are trying to match is a 42% gap, which continues to shape how we look at the business. Where is the business going to come from? How do we focus and refocus on domestic national tourism? Hotel wage growth. So why do we look at this? Hotel wage growth as well as hotel job openings are very good indicators of forward-looking expectations. So while hotel wage growth grew by 4.2%, the number of job openings has seen a sharp decline in Q4 of 18%. Again, the expectation is of softness going into 2026 with some bright green shoots and some bright expectations in some markets due to specific events. Corporate demand is recovering. Group demand actually started the year a bit more optimistic than we were expecting. And of course, budget season was brutal. So what's our US hotel forecast? This comes from the CBRE research team. So stable macro, expectations, job stability overall, we are not seeing any concerns yet. World Cup demand, great expectations. I echo some of the commentary that on the ground, on the cities where we're having games, we are not seeing that ADR growth that we were expecting. Actually, some markets have to walk way back on the increases in ADR that they were expecting for the weekends or weeks where we have games. Some cities are choosing not to do big events at the city level, so the expenditure of the CBBs in terms of leaning onto the celebrations of the FIFA World Cup also is not giving us too warm of a feeling. And again, hopefully international tourism is what is going to drive some compression. Some of our markets have already busy summers, so again, will drive ADR, but cautious optimism. Let's see. Okay, market bifurcations persist. Yes, and we talked about it a little bit earlier as it relates to the 26 expectation of RevPAR growth. We are looking at urban and resort to lead the way with about 2% RevPAR growth. And then luxury, again, we don't see luxury performance is slowing down. We see upper scale, not catching up to luxury, but yes, driving some of our positive sentiment, and continue to see this as the recovery of midweek, which is really helping urban. Bleisure continues to perform for many urban properties. That's when a lot of properties are focusing on amenities, focusing on how do we keep the business in the urban markets, partnering with CBBs to bring more attractions to the city. Sports is also driving a lot, sports and concerts are also driving a lot of this urban leisure demand in addition to corporate. Oops. Markets, well, we have, CBRE is tracking 65 markets. 59 of those markets are showing a forecast for 2026, significantly outpacing the 2019 pre-pandemic levels of performance, but there are 6 specific markets that we're still seeing significant gap between the pre-pandemic levels. And out of these 6 markets, 3 of them are in the Bay Area. I'm from the Bay Area, and we have seen a recovery in 2025, and we're thrilled about. We are expecting a good outcome from the World Cup, particularly as we continue to feature a new and cleaner and AI-driven business and a much more positive conversation. But the Bay Area, out of the 6 markets that are not expecting to even touch the pre-pandemic levels of performance, are in the Bay Area, so unfortunate. And then, as we've been talking about leisure and what we see as really what's driving markets, the smile cities or leisure-centric cities are those that have 20 plus, outpacing the performance of pre-pandemic levels. So this is the last slide, I would say, for 2026. Finding those drivers for, finding the drivers for each property, for each submarket is key to see bottom line performance. Overall, CBRE's sentiment for US growth is still optimistic. The data show excellent, exceeding expectations between November and January. Of course, the world is different between January and now, but we're still holding to that positive momentum for 2026. And I think our forecast for RevPAR growth is between you two, I think it's about 1.2, 1.4. So very good. Thank you so much. There you go.
Thank you, Andrea. Good afternoon.
Good afternoon.
Good afternoon. Is anybody out there? So in 2025, I spent 120 nights in hotels. And people always ask me the same question. How do you stay so thin? Well, last year I went on something called a faith-based diet. That's when you go on Ozempic and you pray that no one asks you. So my name is Kevin Carr. I'm Vice President of Hospitality with Cvent. Many of you are probably familiar with Cvent as a company, but you may not actually know what we do for a living. Cvent at its core is an event technology platform. So we help meeting planners plan, execute, manage, maintain awesome events. About 15 years ago, our meeting planners came to us and said, hey, you do great jobs helping us execute. Can you help us find and manage venues? And from that, we created the Cvent Supplier Network. In our first year, we sourced about $650,000 worth of group business. Last year, we sourced over $18 billion in group business. And it's from all of those RFPs that we are managing through our meeting planners. I'm able to share some of that data where you can hopefully execute and drive more success with your hotels. So what did we see last year? Growth year over year was pretty much flat at about 1%. We actually saw a dip in room nights, but surprisingly, we saw RFP value increase by double digits, which is telling us that our meeting planners are willing to spend more money on their group events. So even though we're seeing some things go down, the value of the RFPs are actually going up. Another thing we see that is interesting, and this is kind of why we continue to be successful, so we're always trying to find more planners for our hotel partners. And in 2025, of all of the RFPs that were sourced through the Cvent Supplier Network, 60% of those were from first-time meeting planners. 60%. 40% were from our current clients. A lot of those are third parties, as you can imagine. That 40% also sources the larger value RFPs. But what we also noticed when we take a deeper dive into our current clients, almost a third of them have new planners that also source Cvent for the first time. And what that tells us is that there is a lot of churn and an awful lot of opportunity to nurture your meeting planner clients. But 60% are new for the first time, which I thought that was pretty startling. Another question we get all the time is, when a meeting planner sends an RFP, how many hotels are copied? Is it 30? Is it 40? The actual answer is 11 on average. Of those 11, 2 just don't respond. Or as my kids say, they ghost their planners. 3 will turn it down for various reasons. So when you receive an RFP, you're actually only competing with about 6 competitors. 6. And as you can see, most of the 11, 8 of the brands are also kind of represented. What we also see is, meeting planners don't, even when they get those 6, sometimes for whatever reason, they're not getting what they want. So they may send it out again to a smaller group. They might add 6, and you can see the responses seem to trickle down when they go through their second and third iteration of that RFP. What you're going to see in this data is the hotels that respond the fastest win the most business. We've been managing and tracking this for probably the last 10 years. That trend continues year over year. What are our booking window trends? Really didn't change much year over year because we do a lot of large groups. So our average is 270 days of booking window. What you also see is that varies by size of event. This is kind of Cvent is a living case study in how we see this go from 90 days to over 200 days. Cvent holds a lot of events. So this week alone, we're probably doing 10 events in North America. Most of those are small, kind of what we call maybe a hotel success group or a customer success group. Those events might be for 60 people. And those are the kind of events that we are managing on a quarterly basis. So right now, my events team is planning for the summer for 3 or 4 events that have maybe 90 room nights. We also do an annual conference. We do a citywide conference every year. This year it's in Nashville. Now, we booked Nashville last year, but we've already booked our 2027 Cvent Connect, and we're in the process of trying to book our 2028. So we're now taking these citywides to 300 to 600 days out as well. Not surprisingly, the more complex RFPs are the ones that are longer. If you're just looking for meeting space only, sleeping rooms only, those are going to be on a tighter window. We have a lot of customers who they might have booked some larger things and they're sitting and they feel very confident for 2027, but they have a lot of need dates in the summer. It's like, what kind of business can we get where we need, we can be a little bit more aggressive on price to fill our hotel. So the good news is we can contact meeting planners on their behalf to show that they have access to that, and then they can manage, maybe it's a meeting space only to get some F&B revenue, or it's sleeping rooms only. Now, about a year or so ago, we created a team called the Cvent Hotel Advisors. Those are former hotelier execs. Maybe they were regional VPs, maybe they were asset managers, et cetera. And we've combined them with our analytics teams because we had a lot of our large group houses say, hey, we need a little bit more advice on how to structure our team. How do I structure our territories? How do we manage quotas? How do I assign a quota? And what we were able to do with that team is really kind of pull back the onion on every RFP from every planner this hotel has ever gotten, and kind of help them build out the proper territory with a little bit more knowledge. For example, you can see that where you see the booking windows change the most. We have the biggest change in 2025 with nonprofits and associations, especially those that got funding from the government. So those are our group events that we are having a little bit more difficult time pinning down because budgets vary so much by, really by association to association. I'm not surprised that pharmaceutical, health sciences are consistent, as is retail and media. We also work with some of these teams to assign territories differently. Because if I'm a hotel trying to pull things from a Chicago market, maybe I'm a regional and that's my territory, I need to understand how the booking windows change from city to city. I know I'm going through this kind of quickly because we only have 10 minutes. All of these slides are going to be available after the presentation. Also, what's important, if you have a Cvent subscription, you have access to both an account manager and a customer success manager. They can take this deep dive into any of your hotels or your regions. So something that you all should take advantage of, assuming you're a Cvent customer. So I talked about earlier speed to lead is one of the things that we're really trying to champion to our hotel partners. In 2019, you'll see the average hotel was taking almost 5 hours to respond to an RFP. Now in 2025, we saw that reduced to about almost 3.5 hours. So your hotelier competitors are being much more aggressive in responding to RFPs on a much more speedy basis. Now, why? Just look at that rank. For the hotels that respond for the first, hotel responds first, they have a 35% chance of winning that business. And as you can see, the second, the third, the fourth, the fifth, they keep going down and down and down. Then it gets a spike after that because the meeting planner probably had to resend this RFP to 5 or 6 more hotels. One of the things that we always try to remind our meeting planners is that there's someone behind the RFP. There is a meeting planner. And it's a very stressful job. And a meeting planner has a boss, right? And that boss wants to know, hey, did you get a hotel yet? I want to do my conference. I'm excited about it. And they're trying to book that conference in a hotel. It's like the most stressful thing that they can do is book the venue, which is why they want to book it so quickly. So if you see, when we're working with our hotel partners, that was one of the first questions they asked us. How can I respond faster? These RFPs, they're asking more complex questions. And we were able to work within their product set, but also some third parties, on how using other technology to help them respond faster to their RFPs. But the goal is to be first. Rate trends, easy for me to say. Not really surprising. You're getting the largest rates when things are out, 200 days plus. Those hotels that are trying to book their hotel, they know they have a empty conference room in 90 days, they're going to be more aggressive. So probably not a big surprise. This is a change in proposed rates in the top 15 markets. Not surprised, my wife's favorite city is New York, and she prefers luxury. So I should be so lucky that she finds a hotel for $426 in New York City, because she's not in fact, I think she's upper luxury versus just upper. But you can also see when you're thinking about what your competitors are, right? So one of the things you're able to track in Cvent is when I get an RFP, where do they also send it? Where, not necessarily the hotel did I send it to, but what other cities did I send it to? Who am I really competing with? Mm-hmm. So if I'm sitting in, let's say, Phoenix, and I know this hotel also went to Dallas, then I need to know what my strategy is. Maybe I'm fine, I'm crushing it, I can keep my rates really high. Or 2, wow, Dallas is my competitor in this opportunity. Maybe I need to be a little bit more aggressive. And of course, wouldn't be a proper deck without some sort of FIFA slide. As you can imagine, the host cities, those 11 host cities that we're all talking about, are really crushing it. You can see their growth in ADR for proposed ADR on these RFPs. They're all going up almost 40% on average. Or if you're lucky enough to be in Kansas City or Houston, you can see they're going up almost 80%. So as I turn it over to Jamie, just real quick, you want to build a moat of speed. You want your teams to be the first people to respond to their RFPs. You want to be in that first batch, right? You don't want to be you don't want to get the RFP from the second batch. You want to respond to the first batch. 1, you want to have a segment and approach by value, and you want to align your pricing with your booking window and your market dynamics. All the things that you have access to with probably your current Cvent environment. So with that, I'm going to turn it over to Jamie to bring us home.
Awesome. All right, so now we've had 50 minutes of hotel data. And now I'm going to talk a little bit about what we're seeing in the short-term rental sector. So I spent 10 years in the hotel industry working with many of my fellow panelists up here. Joined AirDNA in 2020. I now spent 5 years analyzing what's happening across the short-term rental sector. And the short version, it's been very rapid growth over the past few years. The reality is now that a lot of that rapid growth is slowing. So from 2018 to 2015, 160% growth, almost 15% CAGR over that 7-year period. And we are now up to $60 billion of revenue, which is roughly 30% of the hotel industry. So has grown fast, Still has a little while to go to overtake hotels. But when we look at the 2025 KPIs, you do see something that is sort of different, is the growth has slowed considerably. So 6% growth in revenue for 2025. On the demand side, just 4.5%. So if you remember, Jan talked about a declining demand for hotels. Short-term rentals were positive, but when you look throughout the year, so here we have each month of growth for both demand and occupancy, and then I layered on top of that in the orange line what was going on in supply. So no surprise when the green line is above the orange line, that's good, occupancy is increasing. When it drops below, that's not good, and essentially, the first half of the year was great. Jan had the line of when the tariffs happened, the tariffs not only impacted hotels, but they also impacted short-term rentals. So what did we see sort of pre and post tariffs? Yes, the K-shaped economy. So we saw demand and occupancy start to decline for lower priced short-term rentals. Very similar trend played out across the economy. We also saw the decrease in international stays, so Canadians definitely decided they did not like coming down to the US anymore. We track guest origin, and essentially post-May, we saw a 40% decline in Canadian inbound demand that was staying in short-term rentals. That, when we looked at it on a map, you essentially saw a wall across the north where Canadians weren't coming over the border. And then also you saw a southern line. So Canadians travel during the summer to northern border areas, and then down in the winter they fly south and head to Florida, head to Arizona, go out to Hawaii. And we've definitely seen an impact there this winter. Now when we look at where the industry is growing, and this has stayed consistent year after year after year coming out of the pandemic, is the growth has been decidedly in small and mid-sized cities around the country. We've seen demand grow, but as a share, stay relatively steady in the traditional vacation rental markets. And then where we've seen the decline in overall share of demand and actually outright decline in demand is in some of the largest metro areas. And here I define that as the 55 largest metro areas in the US. And want to give a bit of a insight into what we see happening in some of these large cities, because I think it really is interesting when we compare with what's actually happening with hotels in this area, because hotels have been gaining back share from short-term rentals, is that the demand that we see is increasingly non-competitive with hotels. So when you look at longer-term stays, so stays greater than 28 days, grew by almost 9% in 2025. When you look at in total, now that makes up about 29% of stays in these large metro areas, which has grown from just 18% in 2019. So massive overall growth for longer term stays now staying in short-term rentals. And arguably staying in a home when you're staying for a month or longer is much better than being holed up in a hotel. And then when you look at the bedroom composition, so private room, one bedroom, was over 64% of total listings back in 2018, 2019. Now that's dropped to less than half, so more than 50% of units in these large metro areas are 2 or more plus bedrooms, so people looking for more space when they're staying in a short-term rental. So the question now, and this was a big announcement by Airbnb in late 2025, is they're now moving decidedly into hotel distribution. They still see a lot of eyeballs coming onto their platform. They see themselves competing maybe less with the hotel industry and more directly with Booking.com. And they want to be a platform for distributing hotels, especially boutique hotels, which they think could complement short-term rentals and especially urban demand that they already see coming onto their platform. And what was a distribution strategy of we've already got some eyeballs, let's take the existing supply that has already sort of come onto the platform and point it to hotels. Now they've actually hired a team, and they are going heavily into signing on individual properties to make their platform much more competitive with booking. Now, the differentiation we still see with the short-term rental industry, and you could cut this a million different ways, but the one I see as most illustrative is just what we see in terms of overall demand by bedroom count. This looks at the entire US. Still decidedly the growth happening on the 3, 4, 5+ bedrooms, growing significantly higher in terms of overall demand for the US and really throughout the world. So this is where short-term rentals continue to differentiate. Now, digging into some World Cup data, last few minutes, we have put out a World Cup tracker. So every city that's hosting in both the US, Mexico, and Canada, we're showing daily demand updated every week, how that compares versus same time prior year. And in Atlanta, we are seeing decidedly higher occupancies. We're pacing at about 17% on average. During the group stage, almost 20%. And that compares to roughly 8 to 10% of the same time last year. So overall demand and occupancy pacing about double what it was in past last year. When we look at overall occupancy levels among the US cities or global cities, we do see those markets with lower lodging supply generating significantly higher occupancy levels. That tends to make sense. If there's less availability, people do need to book further ahead, and you're seeing that play out. The one difference there, and one market that really stands out to me, is New York and New Jersey. Significantly higher occupancy levels than what you'd expect, given all the room inventory. But I'd note a lot of that short-term rental inventory, almost all of it, will only accommodate month-long stays. So it is an area that maybe is deceivingly high in terms of what people might actually book for the World Cup. And then the big trend that we're going to be tracking going forward is supply. There's one thing that short-term rentals are great at, and cities have been leveraging this to be able to accommodate larger and larger events like the World Cup, is the elasticity of supply. So when demand comes in, supply can expand to accommodate more guests into that market. As we look right now, and I've compared this to June 2025, of how much supply growth we've seen added. So Kansas City is leading at 20% supply growth. Honestly, I expected more markets to look like Kansas City than we see. The fact that we see 5 of these markets have actually seen a decline in overall supply is concerning as we head into the World Cup. And why that is, and Kansas City is a great example. So if we superimpose what happened during Paris in the lead up to the Olympics in 2024, and what I've seen is shown is what it ended up at, 46% supply growth, and then what it was a year in advance, and sort of that progression of supply growth as we got closer to the event. 4 months out, which is when I pulled the data as of February, Paris was at 26% growth. Kansas City, our fastest growing market, is at 20%. Essentially, all of these World Cup markets are pacing well below what I would have expected. And the great example for Atlanta is when we hosted the Super Bowl in February of 2019. We ended up seeing 146% supply growth in Atlanta around the Super Bowl. 4 months prior, we were at 31% growth. And right now in Atlanta, we are sitting at just 4% growth compared to a year before an event. So very much lagging what we've seen in other events. The question I have for you all today, though, is will you help us grow the supply? So Airdine, we did create a fun calculator. Any one of these cities, you can put in your address, put in your bedrooms, and we'll tell you what you could earn. So for fun, I put in the Cigna here. If it was a 4-bedroom house, we'd show that it would earn roughly, and on average, about $12,000 for the length of the Olympics. So this is kind of fun. gives you a sense of what people could earn. We've had a few thousand people fill this out, but as you see on the supply growth, maybe not enough to actually get you to lift your home. So we all really appreciate your time here. We are at time, so I'm going to say goodbye, and we appreciate the Hunter Hotel team for having us.
Thanks so much.